A very warm welcome to our viewers to the brand new episode of Outlook Money's webinar series. This series is a part of the Investor Education and Awareness Initiative of Aditya Birla Sun Life Mutual Fund in association with Outlook Money. I am Nidhi Sinha, editor, Outlook Money, and today our topic of discussion is the Union Budget 2022 personal finance perspectives. So, before we go ahead, let me first introduce our panelists for this discussion. First, I would like to welcome Mr. K.S. Rao, who's the head of Investor Education and Distribution Development at Aditya Birla Sun Life AMC. Mr. Rao intends to take financial literacy and investor education to various demographic segments across geographies to inculcate the savings habit. He has spent about 2 decades in the mutual funds industry and is an alumni of IIM Calcutta. We also have with us Mr. Amit Trivedi, who is an author, speaker, blogger, and trainer, and he has over 26 years of experience in the capital markets. He has authored a number of books related to investing, which includes Riding the Roller Coaster. Last but not the least, we have Mr. Harsh Roongta, a well-known personal finance and tax expert. Mr. Roongta regularly features in various media publications including print, electronic, and digital. He is the founder director of the Association of Registered Investment Advisors. Welcome to this webinar series, gentlemen. So the Union Budget was announced only last week, and that's something that everyone has an eye on because it can have a large impact on personal budgets as well. So it's essential to regroup after the budget to kind of take a stock of how it has affected us, the retail investors, and what should be the way forward in terms of planning and strategizing one's finances. So I'll start with you, Mr. Rao. The budget didn't really change the tax slabs or expand deductions, which was widely expected. We all know that some of the deduction baskets, including the Section 80C, which has a limit of 1.5 lakh, has not been changed for many years now. So how will this lack of action, in a way, on this front affect the finances of people who are already under pressure due to the COVID pain, which hasn't abated until now because there are more and more variants coming in every now and then?
Morning, Nidhi. Thanks for having me here, and good morning to my co-panelist. And great to be here with you all at this point of time to discuss. I mean, yeah, right. This budget, probably most of us we anticipate on the budget is all of us will look. After 1 hour speech, when it comes to the personal budget, and when the announcement will come, which tax slab it is impacted me, and it is but natural. We always look forward. But the best part in this budget is thanks to Honorable Finance Minister. I mean, she has very clearly shown, and this is you can look at this is a stable and predictable tax regime, and one doesn't need to do homework every budget after budget. And probably as a retail, as a personal finance, and myself as an investor, I look at how is my budget impacting for myself. This is a question I ask many of my audience when I do these on-ground sessions. I mean, I ask this poll, I do this poll, how many of you are awaiting for this union budget to happen? Almost every hand gets raised. And I'll ask next question, how many of you got your own budget in place? Hardly few hands gets up. It's like, as a personal finance experts, one need to look at, tell the people, what is that your budget, and this budget is not impacted you, and there is no negative surprise. Itself is a positive surprise, because there is a very possibility in the last 2 years of the pain all of us have undergone, it would have been the citizen, the income tax payer would have taken the more burden to pay more tax, and that way it is a big relief that we doesn't need to pay extra. But all said and done, there are some changes which we need to look. This budget has given. One is a capping on the capital gains surcharge at 15%, and there is a COVID relief for those income. Those of them who lost the family member, and there is a compensation which is coming in, is having a full tax relief. Then there is a one-time window is opened up. If I omitted something on my ITRs, I can do it, and it can be filed within 2 years. And then there are some changes like, your virtual assets, there is a TDS. Probably one need to take that cognizance, stick to your budgets, and still we can plan far better. And it is a time I look at, look at wealth creation rather than big on the tax planning. And if you have done a great tax planning last year, fantastic. If you have not done, this is an opportunity to start doing.
Okay, thank you, Mr. Rao. And Mr. Roongta, I had a similar to what case Mr. Rao was saying. I had a similar question to that. That the tax slabs remain the same. So is it something that your planning should remain the same, or there's something new that you can do this year in terms of, say, change circumstances, or how do you approach your tax saving or tax planning after the budget announcement?
I think two, three things. One, I think the great thing, as Mr. Rao said, what this budget has done is that it clearly, showed that, you need to delink your own planning from one, the government of India's planning, okay, which is what the budget really is. Maybe, if there are some changes in tax, you can take that into account. But otherwise, you need to be drawing your own budget. I mean, as Mr. Rao said, a majority of people, okay, have no idea what their expenses are if you really ask them. And I mean, I'm really quoting from real life experiences when we have sat with clients and when we draw down their cash flows and clients give us, these are my expenses, right? Actually, and then when we proceed ahead based on that, you create a plan and you realize that you're not able to execute that plan. And when you go back and check, you realize that the expense is a multiple of the expense that they had initially given you as an estimate after a lot of cajoling, right? So my point is that preparing that budget, okay, is much more important than looking at tax breaks and things like that. I mean, ultimately, tax is also an expense, right?
Yeah.
So you must know your expenses. And I mean, I'm really, I think very few people know that. So to answer your question, should that be any different? For that to be different, you need a base document, right? You need your this year's budget to see whether you need to change. And this year's budget, so I think a great thing that people can do is have these two separate accounts, an income account and an expense account, right? And because very few people, I've seen people use lots of apps and things like that to try keep track of their expenses. It all starts with good intentions, but then it does not work out because they're not able to keep track. I think having these separate expense account and shifting a fixed amount based on your estimate, you shift there and pay only out of that, whether through a debit card or whatever. Stop using credit cards. Okay. I mean, the credit cards, by expanding the amount of money available to you, you lose track of expenses. So please use from that single expense account. When your debit card does not swipe, you will know that you have exceeded the limit. You can go back and check. But now through a conscious effort, you have to shift some money from your income account to the expense account. That conscious effort itself adds it's a check. It's a momentary check, but it makes you conscious of expenses. It works beautifully. So I think you prepare a budget based on, and there are clients who don't even know what their income is. And they can be forgiven for that because obviously if you are in a profession or if you run a business, your income could be seasonal, it could have variations, but you should have a rough idea of what your income is going to be. And again, that separate income and separate expense is the way that accounts, that is the way that will help you. If you have done this exercise, then the only reason you need to revise it, and please remember, tax is an expense. As long as you treat that as an expense, then anything you do is basically to try and reduce that expense. The only reason you need to change it okay, if there is a change in your income or there is a change in your expense. Okay. And this year, at least this expense called tax, okay, there isn't any serious change. So only from a tax perspective, there is no real need to change. But I would suggest strongly that if you're not maintaining a budget, then please start doing so.
That's very interesting to, it's very important, like you said, to split your expenses and income and have your own budgets more than of course, the government comes with the budget for the nation, but it's important to have your own personal budget to be able to be on track. But there's one section that may get affected because of multiple reasons. First, there are no special reliefs for senior citizens in the budget that we saw. Plus, the income, not the income tax, the interest rates are sort of there are talks of that they are going to rise in the near future. So this question is to you, Mr. Trivedi. What should be their future strategy in this scenario?
Good morning, everybody. And it's a very tricky situation when the interest rates are falling on one side, and because of inflation, the expenses are rising over a period of time. Now, even if the interest rates rise from the current levels, they may or may not be sufficient in comparison to the rates we saw 5 years back or 6 years back, maybe. Having said that, the investment strategy that a senior citizen must deploy is to first of all take an assessment. If I go back around 3 or 4 decades, then probably the longevity was not as much as it is today, which means we are likely to spend more years in retirement. Even people who are retiring from their workforce, we are talking about 2 decades, 2.5 decades kind of time period in retirement. So if you're closer to 60, then you have a long way to go in order to at least plan for your expenses. And when you do plan for that kind of a period, a simple fixed income investment strategy may not be enough because the inflation will take its toll over the years. And that's where you need assets which offer potential, and I'm highlighting potential, not a guaranteed protection against that inflation. But a lot of times people ask this question: should I take that chance or should I not take that chance? Should I take that risk of equity or should I not take that risk of equity? The question is very simple. Do I really want to try to beat inflation, or I simply give in? That's the choice. So that's number one. Number two, if somebody is closer to, let's say, 80, 85, then the situation can become quite different compared to somebody who's closer to 60. Because now we are really not looking at probably, and then let's pray for a healthy and happy life for everybody, but we are probably not looking at a very long lifespan from that point on. In such a case, the chances are majority of the expenses have already come down, because at that age, life becomes a lot more simpler. Expense structure changes except for the medical expenses or the home care related expenses. If those things are provided for, then there's not much to be spent. And majority of the Indians that I know are planning for leaving a legacy for the next generation. So if you're leaving something for the next generation, whether you leave X or 2X or 3X, I think that should not bother you much as long as you're leaving something for the next generation, right? So if I were to come back to that interest rates being at lower levels or rising, my sense is some part of the money should be in short-term debt instruments, so you ride the rising rate cycle. But anyway, you are investing with that mindset that you're not really looking at very long horizon. Number two, on the long term, there are certain fixed income instruments where one can lock money and stay invested without having to worry about where the interest rates are going. And the third is the equity component, as we discussed. So if the money is divided in that manner or diversified, if I were to use the technical term properly, then I think majority of the risks can get taken care of.
So, Mr. Rao, what do you think about that? Is it time to rethink and relook at savings and investments for the general investors, including senior citizens? And what are the ways to do it, according to you?
Thank you so much, Nidhi. Again, I will take from where Harsh sir was talking about tax as a expense. It's if I can draw from there and the savings and investments as a opportunity. I look at two ways. Tax is first part is an expense, and tax can also be a tool to create a wealth. And we used to say paying tax is good to the government, but saving tax is good to you. And if you are planning for your savings and investments very wisely, what you need to do is whatever you are paying off, and how you plan your taxes, not at the end of the year. This year it has given so much of time for us. The next year it is going to be the same regime. Then where I am doing a mistake. For example, myself and Amit, we were talking the other day while filing the returns. We were just looking at our information statement which is coming in, where we have invested, whether it is right, whether something else is showing, and it has given a clarity to us what we need to do very differently. And most of the times we tend to ignore. Some capital gains has come, we have not accounted, and we need to look at that way. And how I can look at, I always keep saying, your asset allocation plays very vital role, and tax planning, use it as a tool to create wealth. And it's like, as Sir was telling earlier, it is an expense, but if you are not planning tax, it will going to be a much biggest liability. And of late, I keep meeting some of those investors in the mutual funds who don't look at ELSS is not a 3-year product, but ELSS is a long-term, even a retirement tool. And I did see, which has gone substantially up, because they were just looking at way back. I remember in 95, 96, somebody is looking at the saving was 30,000 rupees. It's on your equity plans. This is a master equity plans kind of it. And today, those plans, today even 100,000 has become over a crore of rupees. And that's a kind of wealth it is created. And this is a time we need to look for a very, very long term and plan in such a way your taxes for the next fiscal, you start saving from the day one of the this fiscal beginning, maybe in the April beginning. Then I personally feel this is the time where we can look at. And when Amit said about the interest rate cycle, I think one need to stick that kind of probably for a temporary period of time. I can go back to the short-term debt and stay back there and use that regime. My debt allocation can go to the long-term only after the cycle gets little turned, and otherwise stay with your hybrid funds. The fund managers will take care of the cycle. They play very well than what we all play, and the auto asset allocation does happen.
That was very well summed up by you, Mr. Rao, the kind of instruments that investors can look at, and equity especially stands out in the long term. And of course, you need to diversify and be in the short term as well. But we are talking about the tax and budgets. We are discussing that also. So, Mr. Roongta, I wanted to ask you one thing that I think has been troubling a lot of taxpayers is these two tax regimes that have been around for a couple of years, ever since it was announced, I think in 2018. So the old and new tax regimes, some taxpayers, especially the retail taxpayers, there's a lot of confusion in their minds on which one is better for them and how do they decide to choose one of them which will be more suitable for them. So how do they make that distinction and decide what's better for them according to you?
So I think I just need to clarify that when I said that tax is an expense, I think basically obviously it's an expense, and if you are able to reduce that expense, then obviously your budget will have that much more leeway
Right.
to be able to invest for the future. And any investment that leads to a reduction in the tax expenses, okay, is obviously something that is better than an investment of the same type within the same asset class that does not lead to reduction. Having said that, coming to this old and new tax regime, very simply, I think the new tax regime is giving you a trade-off that you do not claim certain deductions. Okay, and if you do not claim those deductions, you are eligible for a slightly gentler tax rate regime. Okay, so you have to look at the what you will be. And fortunately, at least as far as salaried individuals are concerned, they can make this choice from year to year, right? So this year I can choose new regime, next year I can choose old regime, go back to the old regime, the next year after that come back to the new regime. So I mean, this is something that it need not be decided upfront, although I do recommend that it should be, you should have your plan ready, but it need not be decided upfront. Reason I want to actually sort of delink tax, okay? Because see, what are these deductions that are not allowed? There are some things on which you have no control, like say standard deduction, or leave travel allowance and things like that, right? But there
Or
are
even your
things,
EPF and all that, your EPF, your home loan EMIs, they
home
automatically,
loan EMIs, you may not really have a, I mean, you don't take a home loan. I mean, some people do, which is unfortunate, but you don't really take a home loan just for tax reasons, right? You take a home loan to buy a home in which to stay.
Correct.
Tax essentially reduces the cost of the loan, right? Because you get a tax break, the interest cost comes down. So my point is, in this whole deductions, you will have many things that you're not doing for tax reasons. You're not paying education fees for your children because you get a tax deduction. The tax deduction reduces your cost. You would be paying that fees nonetheless, right? Similarly, although again, people don't do it always for that reason, but fortunately now, people will take, say, term insurance, right? You don't take a term insurance for tax reasons. You take a term insurance to protect your family in case of your untimely demise, right? You take a health insurance policy to protect, yourself and your family against unexpected bills. Sure, a tax break on that allows you to reduce the cost of that premium, right? But that cannot be the first consideration. So my point is that this decision whether to go for the old regime or the new regime, okay, is a second decision. You first need to decide what are the things. So if you have prepared a budget, right, then you know that this much money will be going towards college fees. This much money will anyways be going towards buying a term insurance policy, buying a health insurance policy. This much money will be going towards an home loan EMI, right? Now the point only is that for most people, not everybody, but for most people, what I would call these non-discretionary expenditure, okay, this part which you should do irrespective of whether there is a tax break or not, will be so much that the old regime would start making sense for a lot of people. The government hasn't released figures as to how many individuals have shifted to the new regime, and I suspect that's because not too many people have shifted. That's my supposition. Unfortunately, that can only be known through data. But my point is that once you have said these are the things that I do anyways, and this deduction is available to me, then you might find that the old regime makes more sense, right? And then if there are gaps left, that for your from your allocation, you have not reached the 1,50,000 limit. Let us say the fees is 70,000 rupees, and the term insurance is another, say, 30,000 rupees. You still have a 40,000 rupee gap, okay, which you can do. So if you have an equity allocation for that, you can do obviously ELSS. If you have a debt allocation for that, okay, then you can look at the other debt options that are available. When there are these gaps and you have chosen the old regime, as Mr. Rao said, ELSS is a fantastic option to plug that gap, simply because it makes inertia work for you. because 3 years you cannot take out. Post that, people forget about it. And that concept is called dead man's portfolio. The portfolio that does well is the one that nobody looks at for long periods of time, right? ELSS is giving that option, and as Mr. Rao said, it has led to a lot of wealth being created. So to answer your, to answer it in short, I think whether to go for old regime or the new regime should be a function of how you make the budget. And your budget should not be made depending on whether you are going for the new regime or the old regime.
Sure, Mr. Roongta. Of course, it will depend on the expenses that are, eligible for deduction, like you explained so beautifully about the tuition fees and everything else. And what works for you, it really depends on your circumstance and your finances, your personal budget, your planning for your life, of course. And one of the primary tools, of course, is the ELSS. So coming to equity, Mr. Trivedi, the equity market has been volatile, but there, it's been high, it's been low, but largely it's been, above a certain level, and there is exuberance on that front. And if we could look at it, I don't know, objectively, a lot of portfolios are now perhaps tilted more towards equities than earlier. So, do you think with such high levels, given such high levels of markets, it may be time to rebalance also, especially with, there are a lot of things happening. Interest rates may go up, taxes are stable. So, what is, there are no surprises. Now, what you have in front of you. So, what do you think about whether it's the right time to rebalance, and how should one do that?
So first of all, let's understand that equity markets by nature are volatile. If they are not volatile, then there is a problem. So let's accept that. Number two, if equity markets are volatile, then why should I invest in equity markets? And that's where the potential of wealth creation, as both Mr. Roongta and Mr. Rao were discussing, comes in. So there is a potential to create wealth over a long term, but in the short term, it is going to be volatile. And if that's the case, if that's the nature of the market, then all my long-term goals, where I need to generate returns above a certain level, then equity becomes an ideal vehicle. But if I have a short-term horizon, then the volatility becomes too risky for me. So I would rather say avoid equity markets if your goals are short-term, but don't ignore equity markets when the goals are long-term. That's number one. And that has nothing to do with where the interest rates are. It has nothing to do with what the tax structure is, because irrespective of both, this is the potential. And over these various cycles, it is proven time and again that if you invest for a long period, then generally you come out a winner. The same volatility that we talked about can also be turned to your advantage through a wonderful process known as systematic investment plan. When you invest systematically a fixed amount periodically, you make the volatility work in your favor. So you keep accumulating more and more units when the markets are down. You buy fewer units when the markets are up. And over a period of time, when the markets go up, all the accumulations which have happened at lower than average cost, they go up together. And that's how SIPs were taught to me when I started my career in mutual funds, that it works on two primary principles. One is called rupee cost averaging, where the volatility works in your favor, and second is the power of compounding, where the long-term power of wealth creation comes into play. So that's how I would look at investing in equity. And it's I think it's so simple but so profound that how many number of times that you keep repeating, the principles are always extremely useful and powerful for everybody. So just to quickly summarize, number one, for your short-term goals, equity is not the right place. But for the long term, you can't ignore equity. Take the advantage of volatility and the long-term power of compounding through systematic investing. Having said that, you go back to the basics. How do you decide whether the need is short-term or long-term? And that's where the beginning has to be made. What are your financial goals? If you start with those goals in mind, then only you can determine how to go about your investing. The next question comes in, if I'm salaried, yes, I get a monthly salary, but what if I'm not a salaried individual, a professional with uncertain income? What do I do in such a case? In such cases, whenever there is surplus available, periodically that can be parked is one way. It's slightly difficult in terms of disciplined approach that a lot of times when I get surplus, I may not have time, or I may have 1,000 questions whether equity markets are good or not, which scheme is good or not, etc., etc. A simpler approach could be, whenever there is a surplus, keep parking it into a liquid fund, and from there do a systematic transfer plan into an equity fund. Automate the whole process, take the decision out of the equation. If I have to take decisions every now and then, I can paralyze. If I automate the process, then things work smoothly and beautifully. So I would keep it as simple as that.
So equity investing is something that we have to keep discussing over and over again, I think, all of us, because that is something that people understand, but still when the markets go up or they go down, there is this, you feel like, okay, maybe there is time to take action. So like Mr. Trivedi said, the best part is to just automate it, right? You were saying something.
Yeah, now just coming back to, if the portfolios are skewed more in favor of equity, what do you do now? And that's where the principle of rebalancing comes in. And the rebalancing is all about maintaining certain allocation to various investments. It's not completely shifting from one to the other. Recently, in one of the webinars, somebody asked this question. Now, if the equity markets have turned volatile, should I shift my equity mutual fund money into fixed deposits?
Right.
But please don't do that. Rebalancing means only partially shifting, but maintaining a certain percentage allocation to equity, certain percentage allocation to debt, certain percentage allocation to gold, etc., etc. If your equity portfolio has become higher than what your risk profile permits, trim it down. But if your equity allocation is much less than what your risk profile permits or what your needs are, then you've got to increase even when the market levels are reasonably high right now. I mean, and a lot of people are not going to like this statement that at high level you are asking people to invest in equity. All I'm saying is maintain the asset allocation and periodically keep rebalancing. Over a period of time, your portfolio will mature and become very smooth and stable.
Right. Rebalancing is, one of the main, it's very important for your financial goals as well, I think.
And Nidhi, I just wanted to come
Mr.
in there. This, you mentioned about high prices, right? I think, just like Amit said about automating, I think it's very important to automate rebalancing as well. Because otherwise, like every investor, you will get, fall prey to this cycle of greed and fear. So if you set the rules in advance that, I would rebalance periodically on such and such dates, that's one way of doing it. In between, if you want to make provision, you don't necessarily have to, but if you want to make provision, that you define a corridor that, say, if my desired equity allocation is, let's say, 40% or 60%, and if it is going to be more than 65%, then I will not wait for the periodic rebalance. But the rule is defined. Okay. Meanwhile, ignore all noises. All that you do is monitor your asset allocation. Where it triggers a preset rule, you do the rebalancing. Do not go by these markets are high, markets are low. That's a slippery slope down which it's very difficult to maintain your balance. That's the kind of slippery slope it is. When you predefine it, it becomes far easier because you have already predefined it. So you're just following a rule. So I think I just want to re-emphasize what Amit said. Just make it rule-based.
So automate your finances, pre-decide certain rules, and that will make your investing life quite simple, is what I'm getting from both of you. So, Mr. Rao, coming back to the budget a bit. So, the budget focused a lot on certain sectors, such as infrastructure, for example. So, does it make sense to review one's portfolio from that aspect also? in terms of whether to have more exposure to certain sectors or say sectoral funds or whatever. So in that perspective, if you could explain.
Yeah. Thanks, Nidhi. I think, I'll take out from where the rebalancing was there. Probably, rebalancing which part you are doing it. I mean, very nicely put with Harsh sir and Amit on the perspective. You look at whether it's a periodical or on the event happening. But event happening also, you can do the rebalancing, but not the entire assets. Some of the investors where I see there is a strategic allocation, there is a tactical allocation. The strategic allocation will go with a goal-based investment, and tactical will go with the events which are happening. And whether you look at this budget, and if somebody is looking at sectoral and they would like to take the little more risk, yes, they can look at reallocating to the sectors which they expect to do well, but they may or they may not, right? And this budget, if I can look at on two prongs, I mean, one, if I can read the entire economic survey, which looks like, not one sector, but overall Indian economy is looking very well. If I look at on the agriculture, there is a positive side which moved from the last year to this year. Maybe it's a 3.6% contribution to 3.9%. And if I look at the industrial output, it was a negative 7% to the positive 11%. And if I look at services sector, which was at a negative 8% to the positive 8%, means, broadly it is happening across the sectors. Means even if I stay not doing anything and putting with an index fund, still I may do better. But if I'm taking a tactical allocation, yes, you can look at those allocations which can look at, because this budget, I mean, the first part which spoke about, it's a pro-gati, I can call it as a pragati, gati shakti, it is investments, which is talking about infra, which is talking about roads, which is talking about ports, and, look at, but we are not very sure. And budget also spoke about sunrise sectors, and budget also spoke about digital economy. And if you are looking at very tactically, that's, but for a common normal investor, stick to your asset allocation, have a rebalancing, and the asset allocation is going to be very, very key. And if this budget is a fully growth oriented, if you want to have a growth oriented portfolio, I keep telling this growth, GROW, what you need to do is you want to grow your portfolio, focus on your goal based investment, that is a G, and understand your R is that risk management, O is optimization of what is available to you, that is the rebalancing both the experts spoke about. And last but not least, the W, which is wealth of information you need to understand. That's where you need to read Outlook Money and update yourself.
Thank you so much, Mr. Rao, for that. So these short forms that Mr. Rao comes up are really something that, I am planning to note them down in every session so that we can make a list and take it out separately, because these are really useful and interesting. So coming to Mr. Roongta on the budget, one of the major proposals of the budget, and actually we are discussing the budget from the personal finance angle, this is something that we can't ignore, was the taxation on virtual assets, which are popularly known as cryptocurrencies. What do you think about this taxation coming in? Does it mean that the government is kind of opening up to this concept in some ways? Because of this taxation, because a lot of crypto exchanges, we spoke to them for our stories, and they are of course seeing it as a negative, but they're seeing it as a positive also, that at least the dialogue has opened up, the channel has opened up, at least it found a mention. So what are your views on that?
I think, and I've written about this formally as well, I think what the finance minister has done very, very elegantly, okay, is I think this whole issue has been treated extremely elegantly, but there obviously is no recognition. So, I mean, I don't know whether you are aware, but even if you are doing illegal activities, okay, you are supposed to pay tax on that. I mean, there is a case going back under the 1922 Act, right, where there was a smuggler who was caught with the goods, and the goods were confiscated. And when the smuggler filed his tax returns, he claimed the value of those confiscated goods as a deduction. And ultimately, it was allowed because the base nature of the business itself was illegal. That besides. So my point is that just because an activity is taxed does not make it legal. And I think both the finance minister and the finance secretary, both of them have gone on record to say, okay, that clearly just because the proceeds of this are being taxed does not mean it is legitimate. At the same time, I think neither this government or any other government can wish away the existence of this asset. Okay, this is going to be there. I think it also clearly recognizes that whatever needs to be done as a global, because this transcends borders.
Right.
Okay. So very clearly, this whatever strategy is adopted needs to be a global strategy to deal with this. In the meanwhile, I think taxing this at a certain rate, introducing TDS, which sort of allows tracing, okay, is a very good step. So now people, I mean, one of the questions that arises is that how are you going to catch people who do not wish to become known, and how will this tax provision work? So two things. One, at least the people who are within, I mean, people have raised so much money through venture funds, etc. These are players very well within the, formal system. So no player in the formal system can afford to buck a tax requirement. So that is one way of making sure that at least the people who are serious people, okay, are going to make sure that they pay, and therefore that will add traceability to this. The second, okay, is that those people so they say they shift their trading overseas, okay, rather than do it through exchanges in India, right? And which they can, and that's where the global strategy comes in. But suppose they shift it overseas. If they are residents in India, they still have to pay tax on it, right? And they are clearly evading tax. And as and when this gets caught, that's a very powerful thing to put them away. Okay. I don't know if you are aware, but the famous, mafia gangsters in the 30s, okay, they were put away on tax evasion charges because none of the other charges could stick because they would take care of the witnesses. But the tax evasion charges stuck. So I think introducing a specific tax, introducing TDS is a great way to make sure that the formal system brings it into the tax net, and the people who choose to stay out run the risk, okay, of being caught in the future as and when a global strategy gets worked out. And in the meanwhile, of course, let us see what shape the digital rupee that RBI will be bringing out reportedly this year, what shape that has, okay, and how that works out. So I think this kind of a ring fencing approach that the government has introduced, I think is a very elegant way of dealing with a complex issue. It is a very, very complex issue.
Definitely. It's been a smart management, like you put it, in an elegant way, because you bring in taxation. So if lotteries and gambling are under taxation, why not cryptos? And plus the regulation can come later after, the detailed discussions by the government. So, Mr. Trivedi, the union budget is now laid out, and we know what the government plans for the next fiscal. We have, we have the plans in front of us. So, in this backdrop, just to sum up, what are some personal finance lessons that you would want our viewers to leave with, which they can, use to perhaps create their own budget? Like we have all discussed that, how important it is to create your own budgets. Instead of just relying on what the government is announcing and the taxes.
I think the first and foremost thing is to understand what the budget actually is. It is the presentation of the statement of government's accounts in front of the people at large through parliament. Now, as such, for years we used to believe that it's an annual exercise, and it talks about the annual expenses and income or revenues. But what is the expense for? It is actually a resource allocation statement. And how do you want to allocate your resources towards what? So this budget, to that extent, starts with the vision for the next 25 years. So if I want to talk about the next 25 years, then out of my current surpluses or current revenues, how do I allocate money? I think I'll go back to what Harsh sir mentioned initially, that tax is an expense. Similarly, your financial goals are also expenses, deferred expenses. Now, what do you do in such a case? You define various expenses. Some are short-term expenses for your current requirements. And in the budget parlance, it is called the revenue expenditure. And then there are certain expenses which are for capital building, the capital account. Now, that's where you need to identify what kind of India that the government wants to shape. And as an individual, I have to define what kind of life that I want to shape for my family. That's the vision that we start with. And in line with that vision, then I convert that vision into financial goals. Financial goals help me decide the timeline and the amount required. And once that is done, then given my resources, the current resources and future resources, I can lay out a plan. And then that's really where the whole exercise of union budget should be seen in light of my own life. What kind of life that I want to live? And for that, what are the resources and how do I allocate which resources towards what? Let's look at what this government has done. They have increased the allocation to the capital formation rather than revenue expenditure. Revenue expenditure, the jump is not much, but on the capital expenditure, the jump is much bigger. It's a decision that they have clearly mentioned. Do we need to do that? Now, we have certain compulsions. And I mean, at some point in time, I would love to be the government because I can run a deficit budget. But as a household, I don't have that luxury. So what do I do? There are certain compulsory expenses, we call the mandatory expenses. I have to allocate towards those first. But at the same time, there are certain mandatory financial goals, the needs, the long-term needs. And I also need to allocate money for that as well. And that's the balance that one has to strike. And after that, keep generating some surplus. So that's where the whole exercise of planning should come in. Second point is, while the budget is presented on 1st February, my sense is from 2nd February onwards, the department that prepares the budget already has started working for the next year's budget. Right. So basically for us also, the presentation of budget is a one-time exercise, but the preparation of budget is an ongoing exercise. And we need to keep an eye on that as well. Of course, we don't really make too many changes. And this is also one of the lessons from this year's budget, that the taxes are not touched. You don't keep tweaking every now and then. And the fourth one is, this budget, I would give 9 out of 10 when it comes to one particular parameter called boredom. It was a boring budget. Keep your entire financial planning exercise as boring as possible. For interesting things, there are a lot of entertainment avenues. Use those, but keep the personal finance as boring as possible, as disciplined as possible. That's the final message.
Okay. So, Mr. Rao, what is your takeaway from the budget for the taxpayers?
Yeah. It's Amit, it was fantastic. You know, your anecdotes and analogy I loved the most. And I mean, probably I'll take from where you said about this budget, this year as we celebrate Azadi Ki Amrit Mahotsav, and budget and finance minister were very specifically spoke about Amrit Kal. And for any one of us, I mean, if I'm an investor, I mean, earlier Nidhi, you said about equity, and that is a way to go for all of us. And if you are not a risk taker, I think, it's a time to look. It is not a risk, and you're not taking the risk is going to be the biggest risk. Only understand that risk and have one good financial advisor around with you so that you are comfortable. He or she can drive you far. And this budget has come with the 4 pillars, right? The first pillar is all investments on the this Gati Shakti. It's probably for your life, there is something called Gati Shakti. That is, where Amit was talking about the capital expenditure. I mean, capital investment, rather, capital expenditure is that will be creating wealth for you in the long run. And this budget second pillar spoke about the inclusive development. I mean, this inclusive development is not only you grow and you also contribute to someone next to you, probably contribute something to the charity. That inclusive for not only for you, but take others and start investing for the charity. And third, this budget, third pillar was on the, it is on the, it's on the productivity enhancement. Probably each of us need to work how I can make my wealth to grow. I mean, in terms of whether adding my value or adding my value of my investments can go up. And the last one, it spoke about the financing of the investments. And financing of the investments is nothing but financing for my goals. Like, if I can look at my retirement is a goal, my child education is a goal, can I finance for it? If I can put these four pillars into the personal finance, then I can say the final one with a simple acronym. I mean, this Amrit call to come to an investor. Investor need to do AMRUT. That A is an asset allocation, right? Asset allocation will lead you there. I mean, I'm a mutual fund guy. I always say mutual fund sahi hai, how you need to use and what is you need to use it. And the third is R is, I mean, more than the return and the return on the risk you are taking. Look at that ROR. And the U is, it is a time for us to understand more and more every time. We can't just leave it, and upgrade your skills as well as up your savings. It's the both sides that you can work. And the T can come for me on the two angles. The first angle is timing in the market is not possible. Like, you can't time the market, you need to stay invested. And the last but not the least, the other T I want to talk is one need to take action. Most of us, we postponed in, I have seen many investors, they postponed their investing. The money is still lying in the bank account expecting for the corrections. Probably take that action, what you can do. The biggest first action, if you don't want to take any action, go to one good financial advisor. He or she will take an action on your behalf. That's the best way to do it. And that's where the long-term 25 years Amrit Kal for everyone.
Right. So that quite echoed with what was expressed earlier also by Mr. Roongta, that if you don't want to take action, automate your savings, and of course the other option is to go to a financial advisor to put things right, to think through about your investments on your behalf, so that it fits right and it sets right. So, summing up and wrapping up, Mr. Roongta, how do you think the investment portfolio? How some tips for the investment portfolio, if you could give to our viewers in this scenario where the budget has just been announced and there are various other factors in the market right now.
I think the biggest tip is that this is not a this is an ongoing exercise, as Mr. Rao and Amit has also mentioned. This cannot be, I mean, you can look at what tweakings you need to do, okay, but the plan needs to be made. You need to have a vision of the way you want to live, to lead your life. What do you want it to become? And how, therefore, then the next, how are you going to get there? Okay. And I think doing this exercise itself is a very fulfilling exercise. Okay. Most people will need help while they do this. It's not that it can't be done without help, but it is done better when you have help. And of course, I mean, the disclosure there is that is the kind of help that we provide. So at the risk of promoting our profession, it really adds value to what you plan for yourself. One of the things, that people most often mistake, and I'm just going to take 1 minute with that, is that the job of a financial planner is to say, abhi mat kuch kharcha karo, hamesha budhape ke liye bacha ke rakho. Actually, that is an error. That is not what planners do, right? What planners will do, if buying a Rolex watch is your lifelong ambition, right? How to get to that without feeling guilty? If you're going to spend 5 lakhs to buy a Rolex watch, right? While you don't even know whether you have got sufficient investments put aside for your own retirement, for your child's education, buying that, you may buy it because you would have that money, but guilt will stop you from enjoying that. Whereas when you plan that out and you know that you are well on your path to meet those goals. Now when you buy that Rolex watch at 5 lakhs, right, imagine the power and the enjoyment you get, because you are clearly easy in your mind. Yes, my goals for my children is not affected with this Rolex watch. My goal for my own retirement is not affected. And I think delivering that enjoyment of life as you live it, it's a journey. It's not the destination. You have to enjoy the journey, and you enjoy that journey when you plan it well. And I think to plan it well, most people would need the help of advisors. But whether you take the help or not, plan the journey and enjoy the journey. I think that is most important.
Fabulous, sir. It was, summed it up so nicely. It is,
Yes.
I look at like this, true to his name. One doesn't need to be harsh for his spending today, and one need to save for tomorrow, spending it wisely, so that you will have all the harsh. That is a happiness. Harsh to harsh.
Thank you.
On that note, gentlemen, thank you so much. And to our viewers, there were many tips to build a happy life that our experts shared with us. Please join us on the next episode of this webinar series as well. Thank you.
Thank you so much.
Thank you.
Thank you so much. Thanks, Nidhi. Thank you so much.
Thanks a lot.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.